Hello, guys. Welcome to another video with the one and only Josh Lee. Today, I'm going to be talking about a very important topic, especially when you're looking at deals, right? When you're looking at the numbers, when you're trying to make sense of it all, when you're trying to find EBITDA, free cash flow, and ultimately how you value the business. What are the numbers you're basing your valuation off? And this is going to be very important if you're going to be using a leveraged buyout model, aka buying the company using debt and without using any of your own capital. Now, if you don't know who I am the youngest healthcare acquirer, no money down healthcare acquirer in Australian history. So I know what the fuck I'm talking about. I know that this is possible. And I've got guys in many different industries around the world doing the exact same thing. So if you've never done it before, if you've never seen it before, and you're calling bullshit already, I suggest you check yourself. Anyway, let's get into it. I'm going to be talking about cash and accrual accounting. All right, this is going to be very important when you're looking at financial statements. So, first thing, cash accounting. Cash accounting is basically when you record every cash transaction. So you make 100, you record that on the profit and loss. You spend 100, you record that on the profit and loss. Now, a cash accounting, this shows you the cash position, but it's actually not entirely accurate, especially when you start going into larger numbers, more complex businesses. So a good rule of thumb is under $1 million, cash accounting is fine because chances are your business model isn't that sophisticated. You're not selling that many product or services. So it's fine to account by cash accounting. Now, I'll explain why it's not accurate in the next bit, but I want you to start thinking about it. If you just record how much money comes in, how much money goes out. If you're new to business, you think, isn't that how you record how much money you make? It's not entirely accurate. Okay, so I do have my notes here, by the way, so I'm keeping track of what the fuck I'm telling you. So this shows your cash position. It is good and typical for businesses under $1 million. So under $1 million. That's when you start making more than $1 million, that's when you want to start going into accrual accounting. Accrual accounting, basically the difference between accrual accounting and cash accounting is rather than recording by cash transactions, you're recording by invoices. Time of consumption or delivery, right? So you're recording not when the $100 comes in, but when the $100 is being used, right? So I'll show you the example after. Now, accrual accounting is actually a lot more accurate in terms of identifying the true profitability of a company, of a business. So remember, cash accounting shows you the cash position. It shows you how much money is coming in, how much money is coming out. But it's not a good indication of how truly profitable a business is. The reason why is because you might, in a cash accounting scenario, let's say you're recording by financial year. You should be recording by financial year, right? So 1st of July through to 30th of June. Let's say you buy stuff for the next financial year, 30th of June in this year or in the last financial year. If you do cash accounting, that's going to showcase an expense. Let's say you spend 50 grand in that year. That's going to show the expense in that year. But you're buying stuff for the next financial year, right? So you're seeing how it's not accurate because now let's say you only make 50k in profit, but then you just spent that 50k for the next year's stuff. And then it's going to show this year is at a break even. You don't make any profit. But if you did accrual accounting, the stuff that you bought for the next year, you'd record it in the next year, right? So you actually accrue that expense over to transfer, accrue, whatever the fuck. I'm no accountant. I'm a G. I'm a business G. I'm practical. You transfer that expense over to the next year when you actually use it. Now, the accrual, another key difference, the technical difference, is you're utilizing the balance sheet. In cash accounting, you're basically only using the profit and loss statement. In accrual accounting, you are using the balance sheet, because where are you going to record the money that you're not using, right? The money that you need to pay or the money that you're going to get. That's going to be in your receivables and payables. And basically, this is when you have an accountant and bookkeeper, because then they're recording all these things in your profit and loss when you start drawing down or when you start paying the stuff. So you've already gotten the money, you haven't recorded it in your profit and loss, but it's being recorded in the balance sheet. Feel me? Okay, so true usage and consumption of activity. That's what it shows. True usage and consumption. Man, I wish I need to get one of those fucking whiteboard pen things so I can not write like a retard with my mouse. Anyway, I'm going to show you an example of how this works in the practical world, in the real world. Okay, so I'll show you the difference actually. Versus accrual. So cash versus accrual. So let's say someone pays $1,500, and I'm in the clinical world, so $1,500 for a package where they get 10 sessions, right? They pay up front for 10 sessions. In the cash accounting, that would be a income of $1,500. Now, we've already discussed this. What's the problem here? You haven't actually delivered the service yet. So you still owe this customer, right? You still owe this customer $1,500 worth of services. But you've recorded that on the profit and loss statement as a piece of income and there's no expenses. So when you're looking at a business to buy, it's very easy to overinflate or even sometimes under express your true income. Now in the accrual mode, this $1,500 actually gets recorded as a liability. Forget the spelling. As a liability, right? So it's not recorded on the profit and loss. It's recorded on the balance sheet. Right? On the balance sheet as a liability. Now, how does this work on the profit and loss? So when you actually deliver, so remember, they're getting 10 sessions. When this person starts drawing down or using their services, right? So actually, let me go even in more depth for you. Maybe if you're not understanding yet. So they pay on the 30th of June 24. Right? 30th of June 24. If they paid on the 30th of June 24 and you record via cash, then that adds to your profit, right? Adds to your income. But the expense isn't recorded. So when you're just looking at cash, you're like, fuck, I've got an extra $1,500. But then if you do accrual accounting, this income is not recorded. It's recorded as a liability on the balance sheet, right? On the balance sheet for the financial year 25. So this is in financial year 24. Follow me? right? On cash accounting, it would count as income to financial year 24, but in accrual accounting, you would record it as a liability in financial year 25. Now, when does it get recorded as income is when you start using the sessions, right? When the customer starts using the sessions. So it's $150 a pop, $150 per session. Let's say this person starts using them. They do 3, what's that, $450. So 3 of these sessions is $450. And they use it in fucking 1st August 25, right? So that's when you record the income in financial year 25. So even though you got the money here in 24, you're only recording the income when they're being used. So this actually shows you the true profitability of a company because it's showing when you're actually using the things, right? Whether it's money that you get or whether it's money that you need to pay. Right? Like the example before, if you buy something, if you buy 50k worth of stuff for the next financial year, it shouldn't be recorded as an expense for the previous financial year. It should be attributed to the next financial year. So when you're looking at a business you're buying, make sure you differentiate between cash or accrual accounting. You ask them, like, are you using cash or accrual accounting methods? If it's cash basis, the only time you're going to experience a problem with this, like a major problem, is when the business does a lot of these kinds of products where people pay for packages and then they have to draw down on their credits, right? But in, say, the clinical world, in my clinics, people come in and they pay per session. We don't do packages for like treatments with people, with the patients. When they pay, here's $100. I'm going to get a $100 service on the day. That's 99.9% of how we make our money. So we don't actually. This is actually going to be a big problem when I'm looking at clinics. It only becomes a problem when there's a lot of this kind of stuff. When people pay up front for a lot of services and then have to draw down. So one clinic that we're looking at now, it does a lot of Pilates and group class stuff. So people pay up front and they draw down on the credits they have. So when we're looking at the cash accounts of this business, the profit can be overinflated. So when we look at the accrual, when we look at what people are actually using by financial year, what's expired, then we can identify the actual profitability. So I hope that gives you a good understanding of what cash versus accrual accounting looks like and why it's important when you're looking at a business, right? So I don't think I've already given you a summary. Now I'm going to show you the impact on EBITDA, on profitability. So on cash accounting, a business like this might showcase $100,000 in cash accounting, their profits $100,000, but then when you break it down by accrual accounting, when you start breaking down invoices, when services are being used, when things are actually paid for, it might actually show 75k profit. So even though you're banking this much money, you still owe stuff, right? Like you still owe people services, you still owe your suppliers shit. That's why one of my directors hates cash accounting, because it's like, bro, we don't fucking care about your cash position. We want to see your profitability. Like, when are you actually using the money? Because you can make $100,000 in a month, but then you still need to deliver those $100,000 worth of services. Now, most small businesses are in cash accounting mode, right? So even their accountants might not even fucking differentiate. So when you're looking at a business and they're showing 100K or even $1 million in profit, you do your due diligence, right? And this is why, and again, if you have no business experience, you have no idea what the fuck I'm talking about, this is why you build a board of directors, and this is why you use good accountants, transaction accountants, people who know M&A. They're going to look at this. You're going to go through the business, do your due diligence. You're going to knock the profit down, aka knock the price down. And remember, due diligence, D equals price. Right? Due diligence equals knocking the price down. 99.9% of the time when you do due diligence, you're going to be knocking the price down because you're going to find shit in the business, whether it's operational, whether it's fucking some shit with the lease, something that the owner's done 2 years ago. You're going to find something. But 9 times out of 10, you're also going to find that if they're on cash accounting methods, and then you actually break down their accrual numbers, you're going to find that their profitability is a lot less than what they think it is. So, you might be you might agree to a 4 times multiple. That's a big difference, right? Like 400,000 on 100K profit, or 4 times 75. What the fuck's that? Bear with me, I'm no maths genius. 300,000. That's a $100,000 fucking difference. $100,000 difference simply from the way you account. So this is why it's very important to look at cash versus accrual accounting. And this actually took me a while to wrap my head around when I first started looking at numbers, and when one of my directors was like, Josh, are they doing cash or accrual? And I didn't understand the difference. I was like, isn't it the fucking same? Isn't profitability the same? Like, we're getting the money in. Why does it matter? And then once you actually understand, like, when you're buying a business and you've got, okay, I'll show you the live example. So in this one business, we've got about $28,000 worth of shit that the business owes to the clients. Now, if we buy the business and we don't look for this and we don't account for this, we're going to be delivering $28,000 worth of services for free, right? So we're going to pay the price, we're going to pay our multiple, we're going to go through with the transaction, and we're going to deliver all these services for free. But so it's important to find the shit that's unearned, right? This is called unearned income. Unearned income. Right? The example that I showed before about these classes, this $1,500 that you get on day one, that is unearned income until it gets drawn down, until the people actually use their credits, use their services, and you deliver it. That's when it's earned income. That's when it's your earnings. So if you're delivering all these services for free, you're shooting yourself in the foot. So that's when you're buying a business, it's very important to identify what is unearned in the business. And what you do with this number is there's 2 things. First thing is adjust the purchase price. So there's two ways that you can adjust for this value. One is to the purchase price. One is in cash. So you actually get the seller to leave $28,000 in the bank or in receivables for you as the next owner. Common practice in small business, though, is to simply adjust the purchase price. So let's say you buy a company for $400K and they've got $28,000 in unearned income, you just take that off the purchase price. And that makes it easy, it's clean, especially if you're doing an asset sale and you're not doing a share sale. This is easy. Cash, the seller will need to transfer this 28K. And again, this becomes another accounting thing, right? There might be tax payable, there just might be shit that you need to deal with this to account for this 28,000 that's coming into the account. So this is always 90% of the time, adjusting the purchase price is the easiest thing to do. Second thing is the impact on EBITDA. So actually, I want to see. So this number is right now at the time of purchase how much unearned income you have, right? And unearned income on the flip side, there's also the expense side of things, but we don't have to worry about that for now. The impact to the EBITDA, like you want to see what it's like on a recurring basis, year by year, right? Year by year. So you want to see FY 25, 24, 23, right? The difference on the balance sheet and the profit and loss and the movements across the years. That's typically how you find the kind of general pattern, general trend with the unearned income. And this is actually very easy to find if the business is already in accrual mode, right? So if they're already accounting in an accrual mode, it's very easy to identify the unearned income and its impact on true profitability. But if they're all on cash records, to do proper due diligence, you have to dig through line by line, invoice by invoice, and utilization as well. So you have to go through all the invoices that are unearned, right? So like the packages, you have to go through all the package purchases, and then you have to go through how many of these sessions were actually used by clients. And this is when you would take it to your accountants, who, they'll dish it to some intern or some junior analyst to go through the reports and find these items for you. So this is not something that I would get your board of directors to do. A little hack: if you can identify 1 year, right? Let's say I've identified, actually no. So we can identify 1 year, financial year 25. Out of this 28K, let's call it 10K. 10K is attributed to financial year 25. And let's say revenue is stable and consistent, right? Stable and consistent. So it's doing $1 million this year, and then it's doing 1.1 the year before, and the year before it was doing 990. We can see that it's pretty consistent. So we can assume, without looking at 24, 23, 22, we can assume that every year it's going to be about 10K. So if they're on cash records and the profit, we're trying to identify the accrual, the actual profitability of the company, as opposed to relying on cash records, and we've identified in 1 year, let's say the most recent year, it's 10K, we can assume that across every year, that unearned income piece is about 10K. When it's small businesses like this, and when the revenue is stable and consistent, that's when you can be pretty safe in your assumption. But when you're looking at larger businesses, right? So when you're looking at businesses 10 mil, and then the year before that, it was like 6 mil. Year before that, it was like 8 mil. And then when you start going to like 10 mil plus, these companies, like, chances are you're selling a lot more product, a lot more different services, different products, then it's going to become a bitch. And it's not necessarily safe to assume that the unearned income piece is going to be consistent across the years, especially when revenues aren't consistent and the businesses are larger in size. They're selling more product, more services. So I hope this gives you an insight into just even when you initially look at a business, right? Why differentiating between cash and accrual is important, and some of the things to look out for when you're looking at the profit and loss statement and the balance sheet, right? So when you're requesting financials from a seller, you're asking for their profit and loss statements and you're asking for their balance sheets. Right, the reason why you want both is so you can match things up, right? And if they're not fucking accounting properly, then you have to dig even deeper and look at their revenue breakdowns, which is why I always ask in the clinical world, I always ask for billings by practitioner, Just on the initial review, I'll just look for year to date and the last financial year. But on a full review, you want to see all the years, right? You want to see profit and loss, balance sheet, revenue breakdown, and even the breakdown of like how people use shit, if they have that, right? If you can dig that from the business, great. But you want to get all this information year by year to do your proper review and to get a real EBITDA figure. Once you get the EBITDA figure, then you can find the free cash flow, right? To find free cash flow, we need accurate reporting in the profit and loss and in the balance sheet. And if a lot of small business owners who aren't so sophisticated and their accountants aren't doing a good job, they don't record their liabilities, right? The unearned income in their balance sheet. So you probably won't see it in the balance sheet. That's why you need to go the revenue breakdown and even go further than that and actually look at the breakdown of the items that are specifically attributable to unearned income, right? So there are probably a portion of services that are, paid on the spot. You get the money and you deliver it on the day. But then there are going to be a portion of services that people get paid for that need to go on to the balance sheet as liabilities. So this is why it's worth getting a good bookkeeper. This is why it's worth getting a good accountant who understands transactions, right? Buying companies, because general accounting is one thing, but then accounting for the purpose of buying a company and knowing what to look for in terms of unearned income, cash versus accrual. How do you get the accrual numbers from cash records? That becomes a bit more of a nuanced thing. And ultimately, this is the key thing. This is the key thing we're looking for. I mean, these two things are the key things we're looking for: EBITDA and free cash flow. Hope this video helped. Go out there and kill it. Thank you for watching. See you on the next one.